Mortgage layoffs have started and has dire consequences for the economy. I'm your host, Steven Van Metre, and thanks for joining me today. And I've been warning that this rapid rise in interest rates would lead to a collapse in lending demand and ultimately layoffs across the mortgage industry. And now we find out that Wells Fargo is laying off, and that's just the beginning. Let's pick this story up where Wells Fargo starts layoffs in home lending unit. Wells Fargo has begun laying off an undisclosed number of its home lending employees a little more than a week after reporting mortgage origination volume has dropped 33% year over year that the bank confirmed on Friday. The home lending displacements this week are a result of cyclical changes in the broader home lending environment, and they are committed to retaining as many employees as possible and will do everything they can to help identify other opportunities within Wells Fargo. Anonymous posts on the discussion board The Layoff indicate job cuts hit at least 5 markets: Phoenix, San Antonio, Minneapolis, Charlotte, North Carolina, and Des Moines, Iowa. Processing, underwriting, and credit administration teams were notified that their position would be eliminated because of the changing mortgage market. They were given a mere 2-week notice. And this is what's important to understand about the mortgage industry. It's boom or bust. And during boom times, they are hiring like crazy, bringing people in and moving big volumes of loans. And when it's bust, they lay people off, and they do it very, very quickly, or else they go down with a ship, and they don't want that. And this was blamed as a decrease in refinance activity along with higher interest rates for what the CEO called the steepest quarterly decline in the mortgage arena since 2003. The average interest rates accompanying 30-year fixed mortgage have risen above 5% in recent weeks, a figure not seen since 2010. And here you can see the mortgage refinance index is absolutely collapsing, as we've been watching every week now. And as I pointed out, that this collapse in demand will ultimately lead to layoffs, which you're seeing now. And it is very rare. There have been other times where they've seen steep drops, but this one may be for the record books. And we still expect to have decent volumes in the purchase market, but our gain on sale margins will definitely be impacted given that there's still a lot of excess capacity in the system. Well, I'm not sure that there is going to be a big demand in new mortgages as they suggest. Let's take a look at the data and see what it says. And here you can see the MBA purchase index also comes out every Wednesday along with the refinance index. And you can see that it has peaked back here in 2021 and has been steadily heading lower. It is still showing strong levels historically, but the trend is headed down, and perhaps higher interest rates will actually impact the new purchase market. And it's not just Wells Fargo that's on the hot seat with layoffs. Rocket Mortgage trims workforce as home loan market shrinks. The country's largest lender is looking to reduce its workforce amid a shrinking mortgage market following 2 years of record loan volume. Officials said on Monday that Detroit-based Rocket Mortgage and Amrock, its title company, are offering voluntary buyouts to 8% of its employees. Rocket companies, which include Rocket Mortgage, employs 26,000, mostly in Detroit. And it's not just them, it's other people too. Other mortgage lenders have turned involuntary job reductions as business contracts. Last month, New York-based Better Mortgage announced 3,000 in layoffs, a third of its employees in the U.S. and India. The layoffs come after the company fired more than 900 employees via mass Zoom call in December. And mortgage tech firm lays off 200 as rates surge and industry slumps, as Blend Labs sheds 10% of its staff. And it's not alone. And that is the problem here, because they aren't alone. Even Flagstaff Bank reduced its mortgage staff by 20%, or 420 employees. And as I said, once this picks up steam, it doesn't stop. And now we can look at the home data from this week and see that, yeah, this has dire consequences, because wait till we talk about where this goes. Here you can see new home sales in March on a month-over-month basis dropped a whopping 8.6%, putting some doubt in the Wells Fargo CEO's claim that new home sales or new mortgages would drive the market for them. How about pending home sales coming out today in March, down 1.2%? And you can see all of this tells you that demand for loans is going down. And what does that mean for the refinance index? Well, it means it's going to likely head even lower as fewer people demand loans at higher interest rates. Now, if we go back and look at periods where demand for refinances were very low, and we can look at 2019, 2014, and 2000, and look at what happened with mortgage rates. Let's go back here to late 2019. Rates went up a little bit more before they collapsed and went to new all-time lows. Here we see in 2014, rates had already started to come down as applications bottom and would eventually go back to their lows before heading higher. And then in 2019, after peaking, they would make new all-time lows. And that's the thing that most investors don't understand about the bond market, the lending market, is if there's no demand for loans at higher interest rates, you can't sustainably have higher interest rates. And that's why you start to see them come down and eventually make new all-time lows. But that's not the only reason. Let's go on, because the goods trade balance came out today and at record level, now trade deficit at minus 125.32 billion. And what that means is dollars have to get recycled from those trading partners back to the U.S. Well, when they do, they buy U.S. treasuries. And that's why you see when the trade balance widens, here you see in blue as it goes down, what happens to 30-year treasury yields in red? Well, they go down too. And notice how when the trade balance just shrinks, rates tend to push up a little bit, and as trade balance widens, well, rates get pushed down, suggesting that here again, from two different factors, that rates are going to go down. But as we talk about these dire consequences for the economy, think about where this goes. How about furniture stores, appliance stores, your local real estate office, perhaps a notary? All these people, they generate a large amount of their business off of the real estate market, new home sales, pending existing home sales. All that's going to dry up. People at title companies, you have lots of jobs are going to start going away, and that's why the lending market is so critical. That when you see this, it tells you there's no demand for loans at higher rates. Now, if there was demand, if rates were rising and there was an increasing amount of people that wanted to borrow at it, then you could get sustainably higher interest rates. But people don't get it. And this is where retail investors make big mistakes. They look at their statements, they see things aren't going good, they look to see where it's at, and they say, oh, bonds are going down, interest rates or inflation is going up, which really isn't strongly correlated. And so they start selling bonds. They've driven rates up rapidly, and the faster rates go up, the more bond selling they do. And what you've just seen is perhaps the bond market is near a bottom, and based on history, more likely to make new all-time highs, thanks to the fact that lending demand has to come back. And the only way it comes back is if rates plummet. And in the meantime, due to the massive trade deficit and the strong dollar, well, foreign investors and institutions are going to be buying U.S. bonds anyways. So now you understand why everyone gets it wrong, but has dire consequences for the economy, is now layoffs from the real estate industry are likely to spread to the rest of the economy. I'm your host, Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.